You're watching Business Incorporated live from Channels HQ. Coming up, world's largest oil firm, ARAMCO, enters Kenya through a buyout. And Ghana will exempt pension funds from its domestic debt restructuring program. Plus, IMF endorses Uganda's public sector reforms with a $240 million check. Hello and welcome to the program. I'm Ladi Williams. Let's kick off now with the market starting on the African continent there. We'll flip over to the NGX. There we see it was up 0.18%. Last time I checked, we see the South African index there also up 0.37%. Let's move on to other markets we track. North Africa, Egypt there closed up or down yesterday, 0.41%. And we see Kenya also closing yesterday in negative territory, just marginally down 0.05%. Well, let's dig deeper now into the NGX. Let's see what's happening right now. We have Olumide Adesina join us via Zoom. Great to have you, Olumide.
Yeah, thanks for having me, Ladi. Good afternoon.
Good afternoon. So, Olumide, last time I checked, the market was up about 0.18%. How's it looking right now?
Yeah, the Santa rally, looking like a Santa rally. We're seeing buying pressures from major actualized stocks, and that's been triggered. We're seeing record inflows, particularly in banking stocks. If you look at month to date, you see that banks like GT, Zenith have recorded a considerable amount of gains, and that's pretty much on the bet that six banks would definitely make gains from the CBN's cashless policy. And also, interestingly, this afternoon, you could see buying pressure from the only electric listed company. I'm talking of Gary. It had a maximum gain of 10%, and it pushed the stock above 115 naira. Pretty much, USCN also, despite the fact it suffered some selling pressure, you could see record volumes of about 10 million of its shares traded this afternoon. The stock is still at a support level of 10 naira. Investors are still betting on how inflation, inflation is really rallying at 2-decade high latitude. So it's really putting pressure on consumer stocks. When you have high inflation, it's always the narrative that the citizens will be kind of more choosy on what to buy and what to hold. And that's why we're seeing many of these consumer stocks not really doing too much apart from Boa Foods and Dangote Flour relatively. But I think for me, the star of the week has been the banking stocks. Like I mentioned earlier, we're seeing buying pressure. Look at October 6 low, UBA, GT, FCMP, Fidelity, Access, they recorded considerable gains. I think for Dangote, it's been quiet for a while. Despite the fact that we're seeing the stock being stable, you can understand the headwinds we're seeing in emerging in frontier markets outside Nigeria, particularly Ghana and the Francophone countries. The devaluation of their currency has really impacted on earnings in the last year. So investors are kind of very watching on that. Now right. For MTN, I think MTN also still above the support level of 200 naira, and it's really left to be seen if it can break the 250 resistance level. But one of the interesting things is that, despite we're seeing the market on a Santa rally, domestic participation is at record high, while foreign participation is nearly at the decade low. And that's pretty much because of the stringent FX controls by the CBN. You understand that the official rate and the private market is at wide margins, and that makes it difficult for foreign investors to put in money and exit their positions. In fact, reports suggested that we have about $1.8 billion of foreign investment tied and that has really weakened the upside on the longer view. But the positivity is that Nigerian stock market seems to be the star of the season. You know what's happening in the United States and other markets. They are much in the bearish season, while it's a reversal for the Nigerian stock market.
Yeah, Nigerian stock market, the star of 2022. All right, let me take you back now to that Gary Goose stock. Now, what do you see that going in 2023?
I think for me, it's a stock that is interesting to hold because three things. First, you could recall that the federal government is planning to sell other power plants to finance next year budget. You could recall that the Euro bonds market seems to be very expensive for Nigeria to tap into, and the fact that Ghana defaulted debt obligation, it makes it very difficult for Nigeria to have external options. So pretty much, I think that would position Geregu in terms of the fact that it's in private hands, and also it's being run efficiently by the popular Femi Otedola, and you know the antecedents that definitely investors will get value. But the trick about it is that you know it's kind of more on the high capitalized side. So retail investors often ignore that stock. They pretty much go for the insurance sector, and that's why we saw WAPIC rising about 8% today. You know, despite the fact that the insurance sector in Nigeria seems to be lukewarm, though we're seeing premium insurance premium gaining year to year. Having said that, I think we should not also ignore the penny stocks, stocks like Jais Bank, Transcorp. They've also been recording appreciation amount of retail participation. And, you know, interestingly, I think for this year, if you look at Wema, this was a stock that was trading below 1 naira. Now it's over 3.3. And that just tells you what the transformation the management has done. You could recall that Alert has really brought in a lot of customers, and signing in the window on their platform also triggered a lot of millennials to use the new bank app for a lot of transactions. So I think some of the bets are like we're going to see next year. It depends on all what happens in the election. You know, naturally, I think a market-driven candidate will definitely push the market definitely up. Most of these stocks are still on the value that, you know, we complain about lack of foreign participation. So just imagine we have a market-driven president in 2023. Definitely, it means that foreign participation will increase.
All right.
And NSE 30 stocks will definitely gain. So I pretty much think that it all depends on what we have and who becomes the leader. But the trick about it is that the Nigerian economy faces headwinds, petrol subsidy, high inflation, and the fact that oil theft has not really been caught to a great effect. So that also would have an effect on the output for next year.
Okay. All right. All right. Let's hope for a market-moving president in 2023. Thank you so much, Olumide Adesina. Thank you.
Yeah, thanks.
All right, let's flip over to the Middle East now. We see sentiment in the UAE is negative at intraday, down 0.31. Abu Dhabi index, 10,215 points. And we see Dubai there, down 0.20%. Other markets we track there closed, Saudi Arabia and Qatar. We'll see Qatar there closed marginally down 0.08%, while the Saudi index closed down 0.60%. Let's move on to Europe now. For many of those celebrating Christmas this weekend, the traditional meal has become a bit pricier. And that's in Europe. For example, the cost of a Christmas goose is putting feathers in a ruffle, even as Germany's traditional potato salad is growing more expensive. Let's talk to DW Stephen Beasley now from Berlin. Great to have you, Stephen. So just how expensive is the Christmas dinner becoming?
Well, it depends on what's on the menu, but you can rest assured that in general, it's going to be more expensive this year than it was last year. Let's take one popular option here in Germany. and that is Wiener-style pork sausages with potato salad. That's a very humble dish that gained popularity during Germany's poor years and has been passed along throughout the generations. Many people still cook this for Christmas Eve or for Christmas dinner. That's going to be about 20% more expensive this year than it was last year. And that generally follows the rate of inflation for groceries, for food items right now. And that's because of we're seeing the rising cost of energy, of course, and that affects transportation of food items, but also it affects the price of animal feed, for example. So all of this comes down into the price of what we're seeing on the shelves. Now, let's say that you want a fancier option for Christmas this year, another option that's popular here, and that is goose. Well, goose is going to run you about 30% higher than last year. And that's because of an additional factor that's causing prices to rise, and that is the prevalence of the bird flu that's actually reducing bird stocks and driving up prices here in Europe, as in other parts of the world. So as we can see, there are multiple factors that are at play here, not just energy, not just the ones that we've been seeing across the year, but some other ones that have maybe sort of snuck up on us during these big moments when we tend to give out a bit more money.
Right. But what about next year's Christmas? Will it be any more affordable?
Well, it's hard to predict the spread of the bird flu, of course, but economists do have some estimates about inflation, the other factors around the inflation that's hitting broadly across the economy. And some of the latest estimates we've seen is that whereas inflation overall, over this year has been around 7%, a little bit higher than 7%. They're expecting that to tick down to about 6.4% next year for Germany. And remember that individual months here, the rate of inflation has gone much higher than that, higher than 10%, for example. So that will be felt differently across the year. At the same time, core inflation, that is the rate of rising prices when you exclude energy and when you exclude food costs, that's expected to rise next year, actually. And that shows essentially that inflation is spreading, it's broadening across the economy. So that is a little bit worrisome there. But of course, this will depend on the general rate of price increases that we see with energy. And that's dependent, of course, largely on the war. When we talk about affordability, we're also talking about the ability naturally of people to pay for something. And that is dependent upon their real wages. And what we've seen across this year and what we're going to be interested to watch next year is whether real wages will improve, because they've definitely gotten worse this past year as people continue to receive the same amount in their paycheck, and yet they're giving out more for food and other items. Will real wages improve next year? If so, then items will be a bit more affordable as they were before this recent run of inflation. But that is really going to be the sort of the battle points coming into this year, whether wages will start to reflect some of these other prices that we're seeing.
All right, so much for the worker to deal with that. But what can we expect from European markets today?
Well, the DAX began with a light plus to begin to open trading. We're seeing that the FTSE 100 out of London and the CAC 40 out of Paris were both flat today. Of course, it is the day before Christmas, so that also affects the volumes of trading, if not the opening times for some exchanges, including London, for example, only having a half day today. I think what we're seeing is that with U.S. exchanges and Asian exchanges earlier this morning, both of them affected by that latest data coming out of the U.S. yesterday that suggested stronger economic performance than had been anticipated. Generally a good sign, but of course for businesses that could be a bad sign, because it means that the rate of interest rate hikes could continue or even increase in the future, and that of course eats into profit. So that's what investors are watching. The DAX and other European markets ended up lower yesterday because of that data had come out while they were still trading here. So they appear to have shaken that off, or at least the DAX has. We'll see where things go. But there's no further market data that's really going to be pivotal expected today. And then of course we have the holiday on the weekend, and then we'll see what trading looks like next week.
All right, looking out for that Santa rally. Thank you so much. That was Stephen Beardsley right there in Berlin. All right, now let's move on. Now see stock futures inched up in early morning trading today. Futures tied to the Dow Jones Industrial Average, again about 50 points, while the S&P 500 and NASDAQ 100 futures were up about 0.12% and 0.03% respectively. Well, let's get a summary of yesterday's close now from our correspondent, Maria Bird.
The U.S. stock market plunged on Thursday as December sell-offs intensified. It is clear that many investors are concerned that interest rate hikes could increase due to the instability of the stock market. This is all due to the fact that we had a previous session of gains, but this plunge of the marketplace puts the stock market at bay. It is clear that many investors are also going to be watching to see what happens with the corporate sell-offs as we enter into 2023. The Dow Jones closed at 1% down. The S&P 500 closed at 1.4% down. And the heavy tech NASDAQ took a downward spike of 2.2%. Many investors are concerned that this could be a troubling to the beginning of the next year.
Yeah, big sell-offs in the U.S. markets yesterday. I guess no Santa rally in that market. All right, we'll take a break now. When we come back, more stories from the African continent. Just stay with us. Welcome back. Now to our next conversation. We see Kenya is raising $900 million in planned external commercial financing for its fiscal year to June from international banks, according to the finance ministry. Well, like other frontier economies, the East African nation has found it's almost impossible to raise funds from international bond markets this year. Let's talk to Matt Kindigan, our practice leader, Sub-Saharan Africa at Frontier View. Great to have you, Matt. Compliments of the season.
Thank you. Good to have. Well, thanks for having me on the show, and also compliments of the season to you as well.
All right, Matt. So, what does this tell us about the state of public finances there?
Well, in Kenya's case, the fact that the government has struggled to raise financing on international bond markets suggests that public finances are not great. And this is a problem that many emerging market countries, including in sub-Saharan Africa, are struggling with at the moment. It's worth remembering that Kenya actually rode out the COVID pandemic relatively well, and this is because of plummeting global interest rates and also because of support from multilateral institutions like the World Bank and donors. But now the Kenyan government is facing increasingly significant pressures across a number of fronts. The first is that investor and lender sentiment towards emerging markets, including markets like Kenya, where debt to GDP ratios are quite high, the budget deficit is persistently quite high. Sentiment towards these sort of countries has dwindled quite significantly as the global economy has slowed in the face of the war in Ukraine and rising inflation. We're also seeing sharply rising interest rates globally, and this is raising the cost of governments like Kenya servicing its debts. And these rising debt servicing costs are being aggravated by the depreciation of the shilling. So when the government is trying to service its debts in US dollars, it's becoming a lot more expensive. So certainly we are expecting the government to face quite significant fiscal pressures over the course of next year. We're not expecting a default like Ghana, as we've seen over the last week or so, but certainly probably a more severe fiscal adjustment than most people are expecting over the next 6 months.
All right, all eyes still on Ghana, at this time. But how would what's going on with Kenya now? How would that affect the Kenyan shilling?
So our view is that the shilling remains overvalued, and this increases the risk of a sudden or sharp depreciation over the course of 2023. We have seen the central bank try to stabilize the shilling or prevent the shilling from depreciating very significantly. There's a bit of a crawling depreciation at the moment going on against the dollar. But our view is that it's not depreciating fast enough to relieve the current account pressures that the country is facing. This is being driven by the fiscal difficulties, and we've also seen the emergence of an increasingly vibrant parallel currency market in Kenya as a result of shortages of foreign currency available through official channels. And so certainly this is all signs pointing towards a more severe depreciation of the currency. Our base case view is that we're probably going to see a continuation of the crawling peg, maybe a slightly accelerated version of this over the coming months, with the shilling reaching about 130 per dollar by the end of 2023. But we have an increasingly likely downside scenario that could materialize, which involves a very sharp, sudden, and quite extensive depreciation of the shilling over the coming months, especially if government finances are not consolidated. So if the government resists austerity measures over the next few months, or if the parallel market becomes a lot more vibrant, if the parallel rate depreciates very significantly. So base case view is some more depreciation, relatively steady, although there is an increasing downside scenario of a very sharp depreciation against the dollar.
Yeah, and how do you see the Kenyan economy performing next year?
So despite everything that we've just discussed, the Kenyan economy is actually still relatively buoyant. So it has defied expectations by growing very well. at least during the first half of 2022. The growth outlook will slow, in our view, and this is partly a result of weak public finances. Government spending and investment are a very important part or a very important driver of economic growth in Kenya. But we actually are seeing an incredibly resilient private sector, especially services industries, doing exceptionally well in Kenya. We're seeing double-digit growth in industries like healthcare, hospitality, ICT, financial services. And this is very good because it means that the country's not reliant on primary or secondary industries for growth. That said, we are seeing weaker activity in manufacturing and construction, and also the agriculture industry is really struggling in the face of the drought. And if we do see the government forced to introduce very severe austerity measures over the course of the next 6 months, we could see growth slow even further. Our base case view is that the economy will grow by about 4, maybe 5% in 2023. And a downside scenario where the government faces increasing fiscal problems, we're probably going to see growth of about 2 or 3%. So not great by Kenya's historical standards, but not necessarily that bad by global standards. So still relatively upbeat for the next year.
All right, I guess that's good to know, and we'll definitely be tracking that economy going forward. So Christmas this weekend, what's it going to be, Matt? Is it going to be chicken, turkey? What's the plan?
Well, yeah, I'm going to my parents, and they actually have a capon chicken, which is a slightly bigger version of a chicken, halfway between a chicken and a turkey. So I'm looking forward to that.
Fantastic. Thank you so much, Matt Kendiga, Frontier Lead there, Sub-Saharan Africa, Practice Leader. Thank you so much.
Thank you very much.
All right, now let's move on to other stories. Now, see, Saudi Aramco, the world's biggest oil producer, is set to enter the Kenyan market through the acquisition of U.S. motor oil and lubricants group of Valvoline, which has a presence locally. The Competition Authority of Kenya gave Aramco Overseas Company, the investment arm of Saudi Aramco, the nod to acquire the Kenyan operations of VGP Holdings as part of the global deal worth $2.65 billion. The acquisition looks set to trigger shifts in Kenya's fuel lubricants market, as currently dominated by multinational firms such as Vivo, seller of Shell products, and Total Energies and Rubies. And Ghana will exempt pension funds from its domestic debt restructuring program, according to a letter signed by the Finance and Labour Ministers and an alliance of trade unions. Ghana's government, in a bid to mitigate an ongoing economic crisis, has negotiated a staff-level agreement for a $3 billion loan package from the IMF. The country announced a domestic debt exchange program earlier this month and said the external restructuring was being negotiated with creditors. And International Monetary Fund has offered a $240 million 3-year loan to Uganda to support a radical public sector reform agenda. The agenda is anchored on fighting corruption, cutting financial waste, and promoting financial inclusion while sending positive signals to international creditors and credit rating agencies about the country's debt burden. The loan offer comes in the wake of a staff-level agreement reached between the fund and the Ugandan government over a new public sector reform plan that covers 11 broad areas. Disbursement of the loan is subject to IMF Executive Board approval that is expected in 2 weeks' time, according to IMF sources. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Enjoy your Christmas.